What's up, millennials? Welcome to part 5 of this series about investing for beginners. So hopefully by now you have some money left over at the end of the month, and hopefully you also have your financial buffer of at least 3 months and hopefully even 6 months. You probably know by now that investing is more profitable or can be more profitable than saving in the long term. And you probably think that it might be a good idea to start investing yourself instead of giving your money to an investment fund. So in this video, what we're going to do is we're going to talk about one of the easiest strategies out there to get started in the stock market. And this strategy consists of two simple elements. The first element is called ETF, and the second one is called DCA. So in this video, we're going to talk about what these two abbreviations mean. What is an ETF? What is a DCA? Let's find out. Let's first take a look at the first abbreviation, which is the ETF. All right. And a lot of times when I tell people that they should get started in the stock market and they could get an annual return of about 8% per year, they ask me the question, well, okay, that sounds great, but where do I get this 8% per year? Well, something you can do is you can take a look at an index fund, for example, the S&P 500. And as we saw in the last video, we saw that the average return of the S&P 500 was 9.7% over the last 25 years. Now, if we take into account the inflation, we saw that the inflation was around 1.5% each year. So if you subtract that, 9.7 minus 1.5 is about 8% average return per year. So before we take a look at what an ETF exactly is, let's do a very quick recap of what the S&P 500 is. So as we've said before, the S&P 500 is an index fund. What does that mean? Well, it basically means that the S&P 500 is like a basket full of different stocks from the 500 biggest companies in the United States. And as you probably know, the United States is basically the biggest, most important economy at this very moment. So the S&P 500 is generally a very good way to see how the general stock market is doing. So how can you buy an index fund exactly? Well, for that, we need to take a look at an ETF. What does that stand for? What does ETF exactly mean? Well, the abbreviation ETF stands for Exchange Traded Fund. Okay, Exchange Traded Fund. The last word, the word fund, simply refers to, for example, an index fund, like the one we have just been talking about, the S&P 500. Now, these funds are traded on exchanges, and an exchange is simply a place where you can buy and sell stocks. You give your money in exchange for stocks, or you give stocks, you sell stocks in exchange for money back. So these exchanges can be physical, but they also can be digital. These exchanges were usually physical, like the New York Stock Exchange on Wall Street, which you probably have heard of. But nowadays, many of these exchanges have become digital. So that means that for everyone, it's very easy to simply use your computer or your smartphone to go and buy and sell stocks. In the next video, we're going to talk about how you can exactly buy these things, where you should go to, what kind of platforms you can use, or what kind of apps you can use so that you can buy your first ETF. Let's take a look at two of the most popular ETFs out there. Let's first take a look at SPY. That's this one over here. SPY is an ETF that tracks the price of the S&P 500, which we just have been talking about. So here on TradingView, we see a weekly chart of SPY. And that means that every single bar, every vertical bar over here, the green or the red ones, is 1 week of price action. Right now, what we have over here on TradingView is pretty much the last 5 years of price action for the SPY, for the ETF of the S&P 500. And as you can see, well, it generally goes up, right? The general trend is upwards. Sometimes, of course, it goes down a little bit, Goes down here as well in 2018. And of course, during the coronavirus, it has been coming down a lot as well. As you can see, if we quickly take the measurement tool over here, we can see that the S&P 500 has been going down about 35% during the coronavirus. But now, as you can see, well, it's all the way back up at basically the same level as before the coronavirus. So as we have said before, it generally goes up, but sometimes there are moments when the price is going down, right? Now let's take a look at another ETF, which is QQQs or QQQ. And QQQs is an ETF that tracks the Nasdaq. You probably have heard of that as well. As you can see, the graph is quite similar to the S&P 500. It also goes generally up, but the Nasdaq is a little bit stronger, or seems to be a little bit stronger than the SPY. As you can see over here, the price right now is quite a bit higher as before the corona crisis. But in general, we also see that this is basically going up in general, but sometimes you have some dips as well, like in 2018 and during the corona crisis. So basically, if you have these two ETFs, SPY and QQQ, or other ETFs that track the S&P 500 and the Nasdaq, you already have a very nice portfolio, because that way you are already investing in the general stock market. You don't need to be picking all the companies, all the stocks yourself, but you simply buy these two ETFs and then you're already on your way to building a very nice portfolio. Okay, so now you know what an ETF is. So what about the other abbreviation, DCA? Well, DCA stands for dollar cost averaging. And dollar cost averaging basically means that you invest a certain amount of money periodically. So that can be each week or each month or whenever you want, but it has to be a certain period of time, okay? Usually I would say that investing between about each week or each month would be the best idea for most of the investors out there. So why would you do that? Why would you dollar cost average? Well, it's very hard to predict when the stock market is going up or when it's going down, right? So what you want to do is you simply want to pay the average price for your stocks. To explain that a little bit better, let's hop into the charts again and let me explain DCA a little bit better, okay? Okay, so here we are back to the chart of SPY, which is the ETF for the S&P 500. Now, of course, you probably have heard the saying that you should buy low and sell high. But it's super hard to predict when the price is low and when the price is high. Now, if you, for example, would say, okay, I'm going to buy stocks once a year, all right? It could be that you would have bought over here in February 2020 this year. And that would have meant that you would have not been able to take advantage of the cheaper prices due to the corona crisis. You would have paid a quite expensive price for this ETF overall. So what could be your solution? Well, you could start dollar cost averaging. You could tell yourself, okay, I'm going to buy stocks once every month or even every week so that you can take advantage of all the price movements. If it's going up, well, that might mean that you're paying a little bit more than average. And if it goes down, that might mean that you're paying a little bit less than average, right? As we've said before, the general trend of the S&P 500, and therefore also its ETF, SPY, is upward, right? If we would draw a line, for example, from the point where we are right now until about, well, let's say 5 years ago, you can see that sometimes the price is above that line, if this is more or less the average price. Sometimes it's above, and sometimes it's below. Now, thanks to dollar cost averaging, you would simply pay this average price, more or less. Sometimes that might mean that the price that you pay is a little bit more expensive than average, right here. But sometimes you're also paying a price that is cheaper than the average price, like we can see over here and over here. So thanks to dollar cost averaging, you don't really need to worry about all these tops and all these bottoms over here. You don't need to worry about if the price is too high right now or if the price is too low. You don't need to worry about the dips and the tops, right? What you simply do is you invest every week, every 2 weeks, or every month, and that way you simply pay the average price for the stock. There you go, ETF and DCA, one of the easiest strategies out there if you want to get started in the stock market. You don't need to spend any money on any course, for example. You simply follow this strategy and you're good to go right away. But if you do want more information, you can always check out my ebook. You can also look at my glossary or the list of resources, the list of YouTubers that I have for you, so that you can learn even more about investing. And if all that information doesn't help you enough, you can always send me a DM or an email and I will try my best to help you out, all right? So in the next video, what I'm going to do is I'm going to show you how you can buy your first stocks, how you can buy your first ETF, and I'm going to show you various platforms you can use on your computer or on your smartphone. So I hope to see you there. Bye-bye.